Hello, and welcome back to Footnote Finance, the only channel that reads SEC filings so you don't have to dissolve your own retinas on 12-point corporate legal jargon. Today, we need to talk about Tesla, a company currently valued at roughly the same market cap as the next 5 largest automakers combined, which, depending on who you are, either fills you with admiration or a kind of low-level existential dread. Look at this year-to-date chart. It doesn't trade like a mature trillion-dollar manufacturing giant. It trades like a cryptocurrency someone launched on a dare. The believers say it's a robotics and AI company. The short sellers say it's a glorified car company in terminal decline. Both sides argue about this constantly on the internet, which is a great use of everyone's time. But the SEC doesn't care about your Twitter arguments. And when you open the actual 10K and 10Q filings, you realize that Tesla's profitability is resting on a foundation so thin you could read a newspaper through it. So, let's look at the actual bricks. We start with the annual 10K. The headline numbers look like a triumph, nearly $100 billion in total revenue. Ask the average person how Tesla makes its profit, and they'll say, by building and selling electric cars, which is a completely reasonable answer and also, it turns out, not entirely accurate, because we read the footnotes, and the footnotes have opinions. Buried in the revenue breakdown, Tesla quietly declares billions in automotive regulatory credits. Here's how it works. Tesla gets these emissions credits from the government essentially for free, then sells them at a 100% profit margin to legacy automakers like Ford and GM who keep building too many gas-guzzling trucks and need to buy their way out of regulatory trouble. It's a genius business. It's just not the business Tesla tells you it's in.
Pull up the most recent quarterly 10Q and the math becomes uncomfortable. Net income for the quarter, $491 million. Regulatory credits that same quarter, $380 million. Subtract those government carbon credits, and Tesla's actual core business earned just $111 million. On $22 billion in revenue. That is not a margin. That is a rounding error with ambitions. They are not, in any meaningful financial sense, an automaker. They are a carbon credit brokerage that occasionally gives you a Model Y as a promotional item. But even a carbon credit broker has to manufacture something. And to see just how brutal the economics of making physical objects actually are, we need to follow the cash through the system. This is their annual Sankey diagram, the full year picture. Look at that incoming river. Nearly $100 billion flowing into the machine. It feels powerful. It feels like momentum. And then watch what happens as it moves right. Tens of billions gone immediately just to pay for steel, batteries, and factory floors. The machine is expensive to run. That's normal. That's manufacturing. But then you zoom into the current quarter, and you can see the pressure building in real time. $22 billion comes in. $17.67 billion is immediately consumed by cost of revenues alone. Add research and development. Add sales, general, and administrative expenses. And that $22 billion river narrows down to a trickle of $491 million at the bottom line. That is a net profit margin of 2.1%. 2%. Apple runs on 26% margins. 2% isn't a Silicon Valley tech valuation. 2% is the margin of a suburban grocery store quietly hoping nobody steals too much cheese this quarter. That is the business you are paying $1 trillion to own. And if 2% sounds bad, we're not done. Because net income is just an accounting number. It can be shaped and structured. Free cash flow
is what actually lands in the bank account after you pay for everything. It is the closest thing accounting has to objective reality. Look at the Q1 filing. Operating cash flow, $3.94 billion. Sounds strong, until you subtract $2.49 billion in capital expenditures, new factories, equipment, AI infrastructure. That leaves free cash flow of $1.44 billion. For a company valued at over $1 trillion, that is a margin so thin it barely casts a shadow. But the cash flow statement has another story buried inside it. Right here. Increase in inventory. Tesla built $2 billion worth of cars that did not get sold. Those vehicles are currently sitting in outdoor parking lots, depreciating under the sun, representing capital that cannot move until someone buys them. The classic, inescapable nightmare of hardware manufacturing. At scale. And here is where it gets surreal. In that same quarter, the filing shows Tesla transferred $2 billion directly into SpaceX, Elon Musk's other company, as a related party equity investment. Not a footnote, a line item. And the board approved a new performance compensation package for the CEO, with market capitalization targets stretching all the way to $8.5 trillion. For context, that would make Tesla worth nearly 20% of the entire U.S. stock market. At some point, you have to ask, are you investing in a company, or are you crowdfunding a monarchy? Now, when your core car business is barely breathing,
You basically have two choices. Fix the cars, slow, unglamorous work that doesn't generate headlines, or change the subject entirely. Tesla chose option 2. Management looked investors in the eye and said, "Stop thinking about the vehicles. We are an AI and robotics company now." The problem is what their own lawyers wrote down right after. Right here in the risk factors section of their own 10K, the section that legally requires them to tell you the truth, they wrote, "There is no guarantee that we will be able to achieve full autonomy." And even if they somehow pull off the engineering, they warn the rollout faces, quote, "complex and unpredictable regulatory environments." Translation from lawyer to English: we are staking the entire trillion-dollar valuation of this company on a software feature we might never build. And even if our engineers pull off one of the most technically difficult achievements in computing history, a single regulator in Sacramento or Brussels could make it illegal to deploy. That is not a business plan. That is a very expensive coin toss with other people's money. Let's bring this together. Tesla changed the world, genuinely. They forced the entire auto industry to accelerate the electric transition by a decade. That legacy is real. But a stock is not priced on what a company did. It is priced on what it does next. And the SEC filings show you what next actually looks like. A manufacturing business compressed on margins from every direction. A profit number kept above water by selling government credits to rivals, and a valuation that only makes sense if you believe they will conquer global autonomous robotics, something their own lawyers flagged as not guaranteed in a document filed under penalty of law. Elon Musk sells you a science fiction future with genuine conviction. I'm not here to tell you he's wrong. I'm just here to tell you what the footnotes say. And the footnotes are not selling anything. If you want to invest based on what a CEO posts at 3 a.m., Wall Street Bets is right there. But if you want to know what the numbers actually say, subscribe to Footnote Finance. We read the footnotes so you don't have to. See you in the next one.